Dan Deppen joins me here today, and you can learn what his team is up to by going to fusionnotes.com/listeners for all the corresponding links. You'll find a direct link to his site right there in the show notes for you. But Dan, really appreciate your time today. We're going to be talking about notes investing and all the intricacies associated with that. So, Dan, thanks for joining me here.
No, thanks for having me on. Excited to be here.
We won't spend a ton of time on this, but I'm always curious. It seems like some of these professions are accidental. How did you find your way into note investing?
Yeah, it was kind of accidental. I didn't start out looking for it. So for me, I actually came to it from a non-real estate investing background. So, I started my investing career focused on stocks when I was 19 years old, got into doing options and other things, and then eventually wanted to diversify into real estate. And at the time, this was like 2015, 16, 17, in the Denver area where I am. I originally looked at doing single family rentals, and even back then, the cap rates weren't great. And so I started looking at other alternative real estate investments that I could get into. And then somewhere along the line, discovered notes. And notes kind of appealed to me because growing up, my dad and my grandfather were in the loan business, not notes, mortgages specifically. They were doing like consumer loans and other things, but I kind of grew up around loans. And then when I had been in business school, I did a course on fixed income investments that I really liked. That's like bond analysis and stuff, which again is not it's not exactly the same as what I do with notes, but there's a lot of similarities. But that was one of the favorite classes that I took. So when I discovered notes, that niche just really appealed to me. And I also liked it not just because of I like the structure of the deals and I like the analysis, but I like that it was this smaller kind of niche area where you're not competing with everybody and their brother. So if you go into those small areas, you can, kind of figure out your systems. And to me, that's a little bit easier than competing with the masses in some other kinds of areas.
Mm-hmm. Well, I think a lot of people in the real estate world, we're looking for ways in which to diversify our investment portfolio. And it kind of it makes sense that a lot of people would consider notes and maybe some of the similarities there. What do
hmm
you think those people that are in the real estate world, what are some of those things that we might know that would adapt to this strategy?
Well, there's quite a bit, right? I mean, part of it is just the due diligence process on notes. It's quite a different process than, say, buying a rental property, but there are aspects that are similar. Understanding title, understanding property values. When you get into notes, you've got a few wrinkles. Like if you're buying an existing note, which I typically am, so if you're not originating, one of the key differences is you don't get to look inside the property. You're not talking to the borrower. So that's one extra element of risk that sometimes throws people for a little bit of a loop. But quite a few of those skills do tend to translate. So, you could be like me where you come at it without really any real estate background and you can figure it out. But if you do have one, you've done other real estate investments or you're a real estate professional, it certainly gives you a leg up in understanding quite a few things.
So you talked about buying existing performing notes. Could you kind of give me an idea as to if they're performing, why would another institution sell it to you?
Yeah, that's an excellent question. So there are lots of reasons for that. One could be like when I've bought quite a few from smaller note funds that are closing down. So a lot of times someone will set up a fund and they'll design it to run whatever it is, 7, 5, 10 years. And then when the fund gets to the end of its life, if they're not creating a new fund and rolling things over, they'll often liquidate that and sell the assets. So that's where I can get some of my best deals. I often buy from fellow investors. So there are a lot of other folks who do what I do, and they're often they'll sometimes they will often fund these with outside outside money. And so oftentimes those people will have a partner who is funding a note deal, and then that partner wants to move it into something else, like they're going to go do a multifamily deal or some other kind of syndication or something else, and they'll want to liquidate and move the note. So that's another reason they might sell. So there's quite a few reasons that people will turn around and sell notes. It often involves investors moving money from one thing to another because they've got some new hot deal that they want to get into.
You mentioned you get some of your best deals from those that are closing down. Are you saying that you're gonna maybe purchase these less than the note value? Like, how? What do you mean there? I kind of compare this to, like, I buy a lot of distressed properties.
Mm-hmm.
Is there something similar in this world?
Yeah, it's very similar to that, right? So every loan has its principal balance, what the borrower owed. There's some interest rate that the borrower's paying, right? But then when you go to buy that note based on the riskiness of the note, meaning the performance, where it's located, how much the borrower has, well, I'm going to discount that note to the return that makes sense for me. So on a given note, maybe it's written at 8%. But to me, because of the other characteristics of the note, well, if I'm going to buy it, I really need to buy it at 12%. So when I make an offer to the seller, I'm going to discount it to some level to get to the yield that I need. Now, some things to keep in mind with that, and I think just about every note I've bought, except for possibly one or two exceptions, has been at some kind of a discount, right? Now, some of the larger institutions, will sometimes pay face value because they have a very low cost of capital. They might be willing to buy at smaller yields. I've even seen loans sell for above face value, what they call above par. I definitely don't recommend doing that because as an
Hmm.
individual, like let's say a loan has $100,000 balance and you pay 103,000 for it. Well, if the borrower pays off that loan early, you're now going to take a loss. Likewise, one of the things I love about notes is most borrowers don't just make every payment until maturity. Like usually at some point, they'll either pay it off early or refinance the loan. So if I bought that $100,000 loan for $80,000 and the borrower pays off early, now I get a nice gain at that point. So when you're looking at these and you're pricing them, there's the return you're going to get if the borrower just makes every payment per the schedule till the end of maturity. But then there's also the probability that they pay it off early, and now you basically capture that discount that you got when you bought it.
I would think then that these notes that you're talking about are associated with real estate, right? That's how they're
Mm-hmm.
secured.
Yeah,
Have
they
you
are.
had have you had situations where they've defaulted and you've had to foreclose and now you're stuck with a property?
Oh, lots of them. Yeah, and that's where it get. Let me back up. So notes come in like kind of all shapes and sizes, right? So there's everything from super solidly performing with a lot of equity to the other end of the spectrum where, and I don't buy these, but there are notes out there where the borrower hasn't made a payment in over 5 years and the property's vacant. And maybe there's squatters residing in, right? Now,
That's popular in the news right now.
yeah, and I've had that too. So what happens is, as the lender, right, if the borrower is not making payments, I've now got the right to foreclose. But I have a couple options as an investor. Um, One, and I don't do this one, but what some people do is they'll just turn around and resell the note at some loss, right? So if I bought a note, it was performing and now it stops performing, I can certainly turn around and resell that note, but no one's going to pay me what I paid for it. But I could just sort of cut my losses and get out of it. One of my favorite plays is buying loans that are delinquent, but with what I call signs of life. meaning not the loans at the far end of the spectrum where it's vacant and there's tumbleweeds and nobody's made a payment in years. You're never going to get that reperforming again. I like to buy delinquent loans where the borrower's still in the property, so it's still owner occupied. They made at least some payments in the last year. And if I do that, then because I'm buying at a pretty healthy discount, I can but if I do my model correctly, about 65, 70% of the time, I can work out something with the borrower to get them paying again and put some kind of deal in place. Now, that doesn't always work. And so that other 30% or so, they end up going through foreclosure. And then once you get into that foreclosure scenario, there's a lot of different ways it can go. And this is where, as the investor, you got to appreciate that I don't have full control over the deal because there's a borrower on the other end of this who's a human being, and they're going to make what decisions they're going to make, right? And they may be super rational, or sometimes they're not. So, based on experience, I can tell you probabilities of what a borrower is likely to do, but I can never quite tell you definitively how these are going to go down. Now, one of the ways I like to approach it is if I'm going to buy a non-performing note, or a performing note for that matter, but I don't like to buy a note that I'm not willing to go all the way to the mat and foreclose on. One reason is it enforces a certain level of discipline when I'm doing my due diligence. It keeps me from stretching and doing thinner deals that I maybe shouldn't be doing, where I might manage to get myself into some trouble. But the other thing it does for me, and I've had this happen at least 7 or 8 times now, including one just very recently the other week, where there are some borrowers who won't make payments. And then when a lender like me reaches out and is willing to make a deal with them, doesn't want to make a deal, you start the foreclosure process, they don't respond, and then you get all the way up to where they're about to lose the property, and then they make a large reinstatement. So there are just some borrowers where they'll make payments, but only if they feel like they're going to lose the property otherwise. And so by using that model I do, where I don't buy unless I'm willing to foreclose, I capture a lot of those last minute reinstatements that sometimes people with other strategies would miss out on, because maybe they would give up and resell the note before they got to that point. Now, the downside of my strategy is that sometimes I do have to foreclose and I end up with the property, which I don't like doing. So, I'm located in Colorado. There aren't a lot of distressed notes in Colorado, so everything I do is out of state, places like Michigan, Indiana, Mississippi, Carolinas, places like that. So when I end up with an REO, it's out of state. It's kind of a pain to deal with. And then I mentioned earlier that, one of my risks when I buy a note is I can't see the inside, right? So what tends to happen is when you have a borrower who rides the ship down in a foreclosure and has a lender who's kind of actively trying to work with them throughout, they tend to live a rough lifestyle, right? They're not just neglecting their finances. They're not doing maintenance, on the property. It's not that they're deliberately damaging it or anything, but they're just kind of living, I call it like a very laissez-faire lifestyle. So a lot of times by the time you get the property back, it's in pretty rough shape. And that's where I have gotten upside down on a couple of them, right? Even though I make my best estimate of the value. I've had one that was a hoarder house. I had one where there was a big crack in the foundation. You can run into things like that. So there's pros and cons to all the different strategies you can employ with these things.
With all that being said, then you mentioned you don't get to really go into these places and have an idea or an eye on the place to get an idea of the value. How do you do your due diligence then on the property just to make sure?
Yeah. So number one is to always get photos of the property, like no matter what, right? Before I make an offer, I'll do things like look at Google Maps, right? But those photos are often a few years old. And even if they're more recent, you want to make sure you understand the current condition of the property. I haven't had this happen, but I know a friend of mine at least once had one where he looked at the property on Google Maps, got the offer accepted, and then we sent someone out to take photos. The city had actually demolished the property. So there was no house there. There was just a lot. So getting eyes on it is key. And then typically, if it's a non-performing deal where I'm sensitive to the value, I'll have a realtor do a BPO for me, or a broker price opinion. Now, you need to be careful with BPO values, because you can't just take that value and run with it, right? So what the realtor is going to do is they're going to go out, they're going to look at comps, and then they're going to look at the outside condition of the property. And so they'll come up with a value estimate based on comps. They might make some deductions based on flaws they see on the outside of the property, but they're not going to deduct anything from the inside of the property, right? Because they can't see it. So one of the things to keep in mind is that BPO value you're going to get has this implied assumption that the inside of the property is pristine, which if you do end up in that foreclosure scenario, it's never going to be pristine. So what I do is I knock that value down, usually by about 60 to 70%. So I've done enough of these that I've had at least about 15 or so where I've been able to compare the original BPO value and comps that I pulled to what the property actually sold for afterwards. And so there's a lot of variation. Like I've actually had REO properties that sold above my initial value estimate. I've had some that were significantly low. So part of the way you do that is you verify the condition, you get a BPO value, you look at comps, and then when you're running the numbers on your foreclosure scenario, when you're looking at the amount you would sell that property for, either at a sheriff auction or on your own, you need to knock that value down to give yourself a margin of safety. The other thing I've learned the hard way is whatever you see on the outside of the property, like let's say it's peeling paint, rotted wood on a porch, junk in the front yard, whatever you see on the outside, whatever's on the inside is probably going to be worse. So if I see a bunch of stuff on the outside, I'm either going to knock my value estimate down even more, or maybe just not touch it, because the probability of running into a hoarder or something else just becomes too high. So those are things I've just, like I said, unfortunately had to learn kind of the hard way through some experience.
So are you probably using like TaskRabbit or some other service to just send somebody out to take a few?
Yeah, you can do that. There are some BPO services that I use. I use one called Baldwin Advisory Group that actually they contract through a number of BPO services. I can usually get those within a few days. If I'm not as concerned about the value, a lot of properties right now have a lot of equity in them, especially if the loan's been around for a while. So sometimes I just want to verify the condition. And if I do that, I can either just order a property condition report, or I'll even just go to Craigslist and hire someone. It's amazing what people will do for you on Craigslist for pretty cheap. But yeah, those, or I haven't used TaskRabbit, but yeah, you could use something like that as well. It kind of depends on the deal, right? So let's say it's a solidly performing note that was originated several years ago and there's a lot of equity. Yeah, now I just want photos. I just want to make sure the place didn't burn down or something like that. If it's a non-performing deal where where I may end up in foreclosure and the value is more critical, that's where I want a real estate professional involved to get their opinion on the value. So kind of depends on the deal, how I approach that.
Just to remind everybody, head over to fusionnotes.com/listener for all of the corresponding links. That's going to be clickable in the show notes. If you found some value in what we're talking about so far, do us a quick favor, like and subscribe this video. And if you haven't done so already, subscribe to reimastermind.net, the podcast. So, Dan, I'd be curious then, you have this property. What do you typically have to do with it? I know I'm coming from a real estate investing I'm buying these type of distressed properties. Some of our listeners are probably going, "Hey, where can I buy these off of Dan?"
Yeah, so it depends on the deal and it depends on the condition. Okay. Now, if it's a traditional mortgage, now let me back up. So, like I mentioned, all the notes I'm doing are out of state, right? And even when I do non-performing, I'm going out of my way actually not to foreclose because I don't want an REO in another state. That's a pain for me, right? So, but in the scenario where I end up with them, then generally I'm selling them to a local cash buyer, right? I just want to dispense with the property. So it's often a local investor who's maybe going to fix and flip it or fix it up and turn it into a rental or something like that. That's generally how I dispense of these. Now, what I prefer to do, if the property permits it, is I like to sell it to a retail buyer and do seller finance and create a new note. Now, sometimes the condition of the property doesn't really allow that, but my ideal scenario is if the property is in decent shape, I sell it to someone, I do owner finance, and I create a new note. Now I've got another deal, and now I keep going instead of having to go out and find another one. Um, and that gets into another strategy. Again, it's not mine, but like, let's say you're the kind of person who is looking for investment properties, either to turn them into rentals or do fix and flips, and you're looking to buy REOs and you live in a state like Michigan or Indiana or some of these others where these are available, then a lot of times people will buy distressed notes as a low cost REO acquisition strategy. So some people have the strategy, they buy a distressed note and they don't want it to reperform, right? So in that case, they may prefer a property that's actually vacant or prefer one that the borrower is further behind where they're more likely to do a deed in lieu or do what's called a cash for keys deal. Like sometimes what you can do is instead of foreclosing, if you want the property, approach the borrower and say, hey, how about instead of doing this foreclosure, you just sign off the loan and I give you some money for moving expenses in your first month's rent. And now you can get the property back quicker, generally in better condition. And then, you can go do whatever it is you have planned for that property. So notes are fun because there's a lot of flexibility. Like, even though it's kind of a niche, there's niches within that niche that people do.
So, I'd be curious then, and I'm guessing that everybody has the same question. Where do you find these notes? Like, is there a marketplace for this? How do you find
Sort
this
of.
stuff?
Yeah, there is a market. It's not a super liquid market, but it's not as challenging as people think. So, like the one big marketplace is called paperstat.com. So, they built a pretty nice online marketplace. It's kind of like eBay for notes, is the way that I think of it. And there are a lot of not just individual sellers who will put notes on there, but they work with a lot of funds. So they usually have about a couple hundred notes listed on there at any given time. There are a handful of reputable brokers that work with individual investors and funds that if you get on their list, like David Polio at SNSC is one. If you get on his list, he'll send you a couple emails a week with things for sale that you can make offers on. The other thing you can do is there are a number of RIAs. There's one in California. I forget the exact name, but it's the Inland Empire Real Estate Investing something. They do actually a big note exchange for a couple hours every Wednesday. They have a few thousand members, and they do this really cool thing where they start off where at first they talk about okay, who's got money to invest, and so people say like, okay, I've got 20,000 or 50,000 in my self-directed IRA, and then they talk about who has deals or things to sell. And there's quite a bit of activity there. I can send you the link to that later if you want to put it in the show notes. But Goodwin Yee is the guy who runs that. Very cool group. So they're definitely out there. The other thing I recommend is just building your network and letting people know what you do. Some of my best deals are from my network or where they just find me. So one of the challenges in the industry, especially if you go on PaperStack, is unfortunately, a lot of folks, both buyers and sellers, can be kind of flaky, right? Like I've done this before where I've tried to sell a note. I put it out there, I accept an offer, and then someone messes around for a few weeks and then they just sort of flake out. Like they don't really find a problem. They just move on. And I'm annoyed because now I got to start all over with somebody else because the due diligence process for notes, right, takes a few weeks, right? So if you want to buy or sell a note, it's not like buying a stock on E-Trade or buying Bitcoin on Coinbase, right? It takes a few weeks. So when someone flakes out on you and you have to start over, it's a big pain. So if you're clear to your network about what your buy box is and what you're looking for, and you develop a reputation as a reliable buyer, like people know, okay, notes that meet certain characteristics, if we agree on price and nothing's wrong, there's no title flaws or no value issues, I'm going to close them. Like a lot of times people will just call me when they have that situation where they have an investor who wants to move funds and they just want to liquefy this real quick. So there are a lot of different ways you can do it. The market's actually quite large. I think last year there were some statistics that came out recently. It was like 89,000 seller finance notes were created just in like 2023 alone. So while it's a little bit opaque and not real liquid, the actual market is far larger than you would guess.
Mm-hmm. Well, can you give us an insight on like what type of returns are you achieving using this strategy?
Yeah, so it depends on the kind of asset you're buying, right? So let's go to like one end of the spectrum, which would be your very well seasoned, stable performing note with a lot of equity. So like your real like lower risk end of the spectrum, you can very easily get 8 to 10% yields after expenses, like all day long. That's super easy to do. If you want to take some that are maybe there's like a little less equity, or the borrower history is not quite pristine, it's pretty easy to get into the double digits, 12% plus on those. And there's still a lot of margin of safety in those. When you move to the non-performing world, it's kind of the Wild West. I haven't run my numbers on my latest deals lately, but for a while there, I was running easily north of 25% annualized on those. Now, the rub when you go to the non-performing world where you get the higher returns is there's a lot of variability. So like within that like 25% or so, I've got some where there was like an 80% return, and I've got some where there was like a -5% return in there. So as you move from the less risky to the more risky, your return goes up, but then so does your volatility. But I think it's really nice where I like them, where I use them a lot, is in my self-directed IRA. We're all buying notes around a 12% return that are pretty safe. And those are nice because I'm getting a return that beats the long-term average of the stock market, but with a lot of volatility, without nearly as much volatility. And then I've also got a lot of equity protection. So I find it to be a really cool asset class that just has some neat characteristics to it.
Well, could you share us your biggest win when it comes to something like this?
Yeah, so my biggest win was a non-performing note in Memphis, Tennessee. That deal was a little unusual to borrow. So, like I mentioned, mostly when I go into non-performing note deals, I don't want the property. I want to get it to reperform. This was a little different in that I didn't want it to reperform. So the borrower was a serial bankruptcy filer and was very delinquent. Previous lenders had did multiple mods. And this was the kind of lady that just wasn't going to make payments or wasn't going to make them reliably. I got a really good discount when I bought the note. And so we went into this with the intent just to foreclose. Tennessee is one of the better states to operate in. It's what they call a non-judicial state. So the foreclosure process is cheaper and faster than, some of your judicial states, like say Ohio and some others. And the timelines are a little bit more predictable. Okay. I knew going into it that the borrower could file bankruptcy again and delay it. And sure enough, I bought the note, the borrower filed bankruptcy. She didn't, there's a BK13. She made a payment or two, but then didn't follow through on the plan. So we had to get the BK dismissed. At that point, we could start the foreclosure again. And what I was trying to do was I wasn't going to allow the borrower to, I wasn't going to make a deal to keep the borrower in the home because I knew she wouldn't pay. Just there was a lengthy history, right? Like it was plainly clear. But what I did want to do for her was work out a cash for keys arrangement where I would make a payment to her in return for just signing over the property. The advantage of that is, one, it's faster and cheaper than doing the foreclosure, even in a non-judicial state. But two, if I have access to the property, I have all the inside photos. If I can sell it myself through my realtor, I can sell it for a better price than it's going to sell for at a foreclosure auction, right?
Mm-hmm.
And this was a more valuable, a little more higher dollar property than I normally did. So there was plenty of room there to create a win-win where I could give her some money to help with moving instead of her just getting zeroed in the foreclosure. But then I'm going to be able to sell the property for more. So I'm going to win as well. And she would communicate. She would talk to me. She was like very nice, but she would not do a deal. In fact, it was funny because like the last phone calls with her, she's like, Dan, like, because this loan had been passed around to a few different lenders. She's like, the whole time I've had this, you've been the nicest person that I've talked to. Like, you're great. Like, you're wonderful. But I'm not going to do anything. And I was scratching my head. I could not figure out what she was thinking because the foreclosure was coming soon, right? She had just had a bankruptcy that was dismissed. So, like, she couldn't file bankruptcy again and stop the foreclosure. And I couldn't figure out what she was thinking. Well, sure enough, the day before the foreclosure auction, she filed bankruptcy again, which she can legally do, but she must have had the worst bankruptcy lawyer in the world because she could file bankruptcy, but it wasn't stopping the auction. And so the property went to auction. And so it turned out, I think it was overall, it was like an 80% annualized return on that deal that I had, split 50-50 with the funding partner. So it turned out to be a great deal. It could have been a little better if she had done the cash for keys. And one of my lessons learned, because I was confused at what she could have been thinking, if I had been a little more on the ball and realized that, oh, even though she can't, maybe she thinks she can file bankruptcy again. Like if I'd been able to tell her, hey, by the way, if you file bankruptcy again, it's not going to stop the foreclosure auction. Maybe she would have done the cash for keys and we could have both had a better outcome. But it was funny because the only deals she would accept for cash for keys, and mind you, this is after not making payments for 3 years. She wanted $20,000 to move out after living rent free for 3 years, which I was obviously not going to do. So that shows the wavelength she was on, right? That's why I wasn't going to make a deal to keep her in the property because I knew we were going to end up back in that delinquent scenario again.
Yeah, there's been a couple times where we've dealt with somebody whose property is getting foreclosed on, and I mean they were days away, and we just had a window of opportunity in which we could have bought the house and they could have at least walked away with something in their pocket.
Yeah.
It's always kind of floors me as to what's going through their mind. Like in the end, they walked away with nothing versus at least something.
Yeah. I had another one that was in Cincinnati a few years prior where I was trying to work something out with the borrower and she wouldn't. And then she lost the property. And the day of the court case where she lost the property, she called me. And I'm like, oh, this could be an interesting call. But I picked it up because I wanted to see like what she was planning because she was still there. I didn't know if I was going to have to do an eviction. And she was just really sad. And she goes, is there anything we can do now? And I'm like, well, no, the gavel came down, right? And I had been trying to do stuff with her for months. And she, what she said to me, she said, yeah, I didn't think that was going to happen. And I don't know how she could have expected anything else because it was clear cut that was going to happen. But yeah, it's tough. And I think some of these, like at least those two cases, right? These were loans that had been delinquent for a long time. And they had lenders that tried to work something out with the borrower and then gave up and resold the note. So I don't know if that kind of like trained them to assume that foreclosure, they were never going to actually lose the property. I don't know. It's hard to say, but it's definitely sad when they make a decision where it's way worse for them, but it's also kind of worse for me as the investor, where they could have made a decision that was better for everybody. So yeah, not everybody, you can't count on everybody doing the completely rational thing, just dealing with humans. So
Yeah. That's the only thing that is predictable with humans is how unpredictable it can be.
yeah, but what I say is people tend to act in their own best interest, but you can't depend on that 100%.
Yeah. Well, we don't want to paint everything rosy regarding this. I mean, 80+% return on one deal is unbelievable. Like, but you mentioned like early on that you have been upside down on a couple deals. Can you give us a kind of like a bad case scenario and what you learned from it?
Yeah, I'll give you the worst one. This was in Buncie, Indiana. It was a non-performing note. Took it through the foreclosure process. Could never make contact with the borrower at all throughout it. I think I was into the deal for like 60,000. I think I bought them for like 50, 60,000, something like that. Took the property back and then found out it was a full-blown hoarder house. So this was an 1,800 square foot house that literally had waist deep trash throughout. It took 4 40-yard dumpsters worth of stuff to get everything out. And it was in rough shape. And, this was one where I mentioned earlier, like in the due diligence, right? Like there were some signs on the outside that this house may not be in great shape that I kind of overlooked. That back then, this was one of my earlier deals too. So anyhow, house was in rough shape, had to pay for an expensive clean out. And then once I got it cleaned out, put it on the market, and the best cash offer I was going to get was going to result in about a $20,000 loss, right? And then the bones of the house were actually pretty good. I'm like, well, I can rehab my way out of this because I got a bunch of estimates. Okay, I'm going to do the kitchen, I'm going to do carpet, and do the wall, I'm going to do a few things, spruce this thing up. And then, it looked like I could rehab my way out of it. Of course, I had, all kinds of problems with contractors. We found other stuff. The timeline drug out. When it was all said and done and I sold the property, I lost 19,000. So I saved myself like a tiny bit of money on the rehab, but I probably made like about $2 an hour on the rehab work that saved me the 1,000. So that was my worst one by far. But it's interesting how you can usually find a way to weasel out of these. Like there's usually equity in there, and even if the house is more beat up than what you had anticipated, it's usually not as bad as you could think. Or if you can get creative with seller finance options when you dispose of it, you can usually maneuver out some way or another. But yeah, that one I got drilled on.
Yeah. We had a hoarder house once where when we cleaned it out, we found an extra bathroom.
Oh wow, that's crazy. Yeah,
so there's a we were completely unaware of. So that was a treat in that situation. But you can
yeah.
they it hides a lot of stuff.
I actually had the opposite once. It was not a hoarder house, but it was supposed to be a 2 bathroom. And when we got like by all the the county records, the property listing, when we got in, it was 1 bathroom. So I don't know how that happened.
Yeah. Huh. Well, just to remind everybody one more time, head over to fusionnotes.com/listeners. That's going to be a clickable link in the show notes. Before we jump into the rapid fire questions, Dan, is there a question or concept you think we should have covered here today?
No, I think we covered it pretty well. I guess the one thing maybe we could get into at a future time was how to use outside funding for note deals, because that's what I do for most of my, at least the ones that are not in my self-directed IRA. So there are a lot of investors who are happy with high single-digit returns backed by performing notes, but they don't necessarily want to, do all the work to get spun up to build a machine to like buy these and do the due diligence themselves. So there are some creative things you can do with hypothecations and partials and joint ventures. That's probably a whole topic for its own podcast someday. But,
Sure. Yeah, that'd probably be a great conversation. In the meantime, though, if they go to your website, could they learn a little bit about that?
yeah, they absolutely can. Yeah, they'll find a lot of resources there. And I think I got some of my case studies and things on there, and links to my YouTube channel. I have a bunch of videos that cover a lot of these different topics.
Sure. Well, if you're ready, we'll jump into some of these rapid fire questions.
Yeah, sounds good.
What lie do real estate investors tell themselves and sometimes to others?
Oh, the value of the property. Yeah, they're always overly optimistic about what the property's worth. And like I said, especially if it's a note deal, if you end up in a foreclosure scenario, the property is always going to be worth less. Because think about it, right? Like the ones you buy where the property value is actually really good, well, that's not going to see a foreclosure because the borrower's probably not going to let it go. The ones that are worth less are the ones where the borrower is more likely to let it go. So those are the ones that you see. But yeah, to me, it's the property values.
Do you have a book recommendation, or what are you reading right now?
Ooh. My recommendation, I just went through this book very recently, is Buy Back Your Time by Dan Martell. So he talks about, everybody talks about hiring assistants and hiring help. He talks about doing it not so much to grow your business, but buying back your time. And so I built this whole matrix on what I spend my time on and what's the highest value and I like the most. And so that's one that I think will help people a lot.
If you could go back in time and give your younger self one piece of advice, what would that be?
Start earlier. Yeah, I mean, I think I started in notes about 2017. Oh man, if I had started like early 2000s before the financial crisis and been able to buy through there, that would have been fantastic. Plus, like I said, like some of these lessons, right, with the paying attention to things on the outside with the hoarder house or learning how much to knock down BPO values. What's cool about all these strategies, not just notes, but other forms of real estate investing, right, is you learn lessons and you get better as you go. So the more time you give yourself, the better.
What single strategy, process, or tool have you implemented that has had the biggest time-saving impact to your business?
I would say probably Pipedrive for my CRM. I use it. I kind of use Active Campaign for my CRM, but I actually have kind of bastardized it as a project management tool to keep track of my portfolio and set reminders. Especially when you get into like, if you start getting above 10 notes, it's hard. You can't keep track of everything in your head. When you go up above 50, it definitely becomes difficult. So that's just helpful for me to set reminders and keep notes. And so it makes it real easy to know what I need to do when.
Sure. Well, Dan, this has been a fantastic conversation. I'm going to direct everybody to your website one more time, fusionnotes.com/listeners, where you're going to find a bunch of resources there. But really great conversation. Appreciate the value you brought to this episode, and I hope we'll chat again sometime very soon.
Yeah, for sure. Thanks again for having me on. I appreciate it.